How is China's economic strategy reshaping the world economy, and what could this mean for the US? Let's dive in. We've seen China making some intriguing moves in the economic chess game. It all started back in 2021, when China began to sell off US Treasury securities, a trend that has only accelerated recently. In fact, China has sold off a staggering $300 billion worth of US Treasuries since then. But why would China do this? Well, it's believed to be an attempt to bolster its weakening currency. As China's growth slows and exports to the US decline, the country has fewer dollars to invest in US Treasuries, so they're selling them off instead. This strategy is not without its risks, though. As the second largest foreign holder of US Treasury securities, China's actions could have a significant impact on the US economy. Fast forward to August of 2023, and we see China selling the most US assets in 4 years, dumping $21 billion worth of US stock and Treasury bonds. This is the highest amount in 4 years, further indicating China's commitment to this strategy. China's actions are not happening in a vacuum. They coincide with the Federal Reserve's quantitative tightening, the US credit downgrade, Japan's exit from its yield curve control policy, and increased Treasury debt issuance. These factors together could mean that even a weak US jobs report may not lower rates significantly. As the second largest foreign holder of US Treasury securities, China's actions have significant implications for the US economy. So how does China's sell-off of US Treasuries impact the American economy? Well, it's a bit like a ripple effect. As China, the second largest foreign holder of US Treasuries, sells off its holdings, it creates a surge in US bond yields. This means that the cost of borrowing for the US government increases. Now, this is not an isolated event. Other factors are also at play here, such as the Federal Reserve's quantitative tightening, which is essentially a reversal of the policies that were put in place to stimulate the economy during the financial crisis. Moreover, the US credit downgrade and the increased issuance of Treasury debt are also contributing to the rising bond yields. These higher yields could mean a permanent increase in the cost of capital. That's a fancy way of saying that it might become more expensive for businesses to borrow money to invest and grow, which could potentially slow down economic growth. This ripple effect doesn't stop there. It could also have implications for the US jobs market. With businesses facing higher costs to borrow, they might cut back on hiring, which could lead to a weaker jobs report. Despite these challenges, it's important to remember that the economy is a complex system, and many factors will influence its future trajectory. So what can we expect going forward? Well, it's clear that China's economic strategy is a significant factor to keep in mind. The possibility of further sell-offs from China could continue to impact the US economy, but it's not just China we need to watch. Other global investors could follow suit, leading to a broader sell-off in the US bond market. But what about the potential for a bond market rally? Some strategists suggest this could occur in the event of a financial shock or recession. This might seem counterintuitive, but in times of economic uncertainty, investors often turn to so-called safe haven assets like US Treasuries. This increased demand could push bond prices higher and yields lower, essentially creating a rally in the bond market. However, it's important to note that these are just potential scenarios. The reality could unfold in a myriad of ways, influenced by a host of factors beyond China's economic strategy. These could include everything from changes in US monetary policy to shifts in global geopolitical dynamics. So where does this leave us? Well, it underscores the importance of staying informed about global economic trends. By keeping a close eye on the actions of China and other major players, we can better understand the potential implications for the US economy. As always, the future is uncertain. But by staying informed about global economic trends, we can better navigate the challenges and opportunities that lie ahead.